Have you noticed that gold looked almost unstoppable in 2025, but in 2026 the picture started to change? That change did not happen because gold suddenly became a bad asset. It happened because the market environment became less favorable than it was during the powerful run from 2023 through 25. From 2023 to 2025, gold had almost everything working in its favor. Geopolitical tensions were high. Central banks kept buying gold aggressively. Investors wanted safe haven protection, and expectations for easier monetary policy reduced the opportunity cost of holding a non-yielding asset. That combination created a very strong tailwind. Gold was not just rising because of one reason. It was rising because several major macro forces were all pushing in the same direction at the same time. But in 2026, that setup changed. First, gold entered 2026 after already making a very large move. When any asset runs up strongly for multiple years, the easy upside is usually gone. The market has already priced in a lot of the good news, and it becomes harder to keep getting the same kind of explosive returns without a brand new catalyst. Second, higher real interest rates and a stronger US dollar became a bigger headwind. Gold does not pay interest, so when cash and bonds offer more yield, investors often become less aggressive about adding more gold exposure. Third, risk assets became stronger competition. Big tech, AI, and data center spending created excitement in the equity market, and when investors feel confident chasing higher growth opportunities, gold often loses some of its tactical appeal. So this is the key point. Gold in 2026 did not lose all of its long-term value. But it did lose the extremely favorable momentum setup that made 2025 so strong. Now let's talk about the historical pattern. Historically, gold often does not repeat huge gains year after year forever. After a strong multi-year rally, gold frequently enters a phase of consolidation, sideways trading, or smaller returns while the market absorbs the prior move and waits for a new macro driver. That is why many investors should be careful about assuming that because gold did very well in 2023, 2024, and 2025, it must also do very well in 2026 and 2027. Markets usually do not reward the same trade at the same pace forever. Now, this does not automatically mean gold has to crash. Some major institutions still see long-term support from geopolitical risk, high debt levels, and central bank demand. But the likely environment looks more like slower gains, choppier trading, and a more balanced risk-reward setup rather than another straight-up move. So the conclusion is simple. Gold was highly favorable in 2025 because many bullish forces aligned at once. In 2026, those forces became less powerful, less surprising, and more fully priced in. Historically, after a very strong 3-year run, it is reasonable to expect lower future returns, more consolidation, and tougher conditions in 2026 and maybe 2027 unless a new macro shock appears. If you own gold now, the smarter mindset may be to treat it less like a fast momentum trade and more like a hedge, a diversifier, or a position to trade selectively around major macro levels. If you enjoy this video, make sure to like, comment, subscribe, and turn on notifications to not miss out on my next videos.